It's been a while. I'm very happy to be back today. Just by myself, going to do a short, sweet little recap and rundown of what I'm expecting, things that have happened since I've been gone. But if there's one thing that we should pretty much know at this point, is that you should not trust the markets. Not financial advice, obviously, but more when we get into Money Never Sleeps. Welcome back to Money Never Sleeps. Joined by no one today, just me. J Web, hopefully he's feeling better. Should be back for Wednesday. If not, obviously one of us will be here because it is a pretty big week. But before we get into any of that, nothing we say is financial advice. Nothing I say is financial advice. I'm not a financial advisor. Everything I say is pretty much my own opinion. I would do your own research or consult with your financial advisor before making any decisions which impact your financial situation. With that said, all done out of the way, we're just going to be talking about some of what's going on in the market. So let's do a quick rundown of what's ahead of us this week, and then we can kind of go back and discuss some of the things that have happened because I do have some pretty big concerns with not only specific stocks but also things that I'm seeing in the general market itself. And it kind of is better to a lot more time for that, in my opinion. So let's just pull up the economic calendar on Market Watch, and we can take a look at what we're seeing for the week ahead. Now, excuse me. Uh, Tonight is a pretty big night, considering that I believe Donald Trump is going to be coming back on Twitter. I already seen an ad on his Twitter account, but coming back to speak with Elon Musk. So that's going to be interesting to see how that impacts markets, futures, crypto. I think crypto is going to be more volatile, obviously, with the market being open 24/7. But let's take a look at what we're looking at for this week in terms of U.S. economic reports and Fed speakers. Today, we got monthly U.S. federal budget. Okay, boring. Tuesday, anything? Yeah, we got core PPI, and we get core PPI and PPI before CPI. It looks like this time around, which is interesting. Usually we get CPI before PPI. Let's see how that comes in. That might be telling of what CPI may be looking like. But Wednesday is a big day. We got consumer price index. We got core CPI. That's going to really indicate whether the Fed is in a position they feel like they can be cutting. It seems more or less that the labor market has weakened enough for that warrants a Fed cut in September. But again, who knows at this point? I'm more on the side of that there's going to be multiple cuts this year, but we'll take each one as it comes. But Wednesday, definitely a big day. We're going to have a show that day. And Thursday is one that I'm more so looking at. It's going to be really important. Obviously, initial jobless claims. People still believe this thing is going to be strong. You know, it's coming in last, I believe, what was it, 233,000 last time. This comes in way stronger than expected. I misspoke earlier. People think it's going to come in at expectation. If it comes in way worse, obviously that's going to warrant a Fed cut even more so. So that's going to be one that's going to be very interesting to see. We're seeing the labor market really just get really shitty at this point. And I mean that in a way where you're not seeing as many hirings, but you're also starting to see a lot of the hours completely go to the point where people are just unemployed at this point. A lot more layoffs that are happening. I mean, if we just look at Intel last week, shit ton of layoffs that were announced. There's a lot more that are coming, and we have just scratched the surface of it. And I don't think that it's going to stop for probably a year or so once we do get a crash, if we do get a crash. That being said, but Thursday we also have some manufacturing data, both Philly and Empire State, that's going to tell us whether we're in recessionary territory or not. We got U.S. retail sales, import price index, import industrial production. Let's see what else we got. Housing starts, building permits, home builder confidence. So there's a couple of things that we're going to be taking a look at later this week, but yeah, I'm not necessarily too concerned about it. We'll cross that bridge when we get to it. Sorry, flying around me right now. Almost the end of summer. Let's see what else we got here. So that being said, for the rest of the week, it seems like we had some definitely some things that are going to be very volatile. Not to forget also that we are in the midst of earnings season, which we have Walmart, Home Depot, Alibaba, a couple of other ones that are reporting earnings this week. Very important to see the strength of the consumer. It seems like Walmart obviously would be pretty telling if the consumer is spending more or less. Probably more people shopping at Walmart, but even if Walmart starts to see a pullback in consumers shopping, maybe people are just like holding off. I did see Unusual Whales post earlier today, which maybe I can pull it up at some point during the show. We discussed a lot of consumers are holding back on their expenses, primarily groceries. Not a great sign, but people have to survive somehow when rates are five and a half, five and a quarter, five and a half, and we're starting to see a lot of liquidity kind of get really tight in the system. So that being said, oh, sorry, one second. Excuse me. That being said, we got to talk about what's going on in the world. And last week, something very big happened. We talked about the yen carry trade almost a year ago. It was back in August, early August. And 1 year later, we see the Bank of Japan raise rates finally, and that trade kind of unwinded. Now we're getting people at JP Morgan that are saying that 75% of the trade it has unwound. There's not, so they're saying there's a lot less risk in the carry trade. But then you get something like this today, which is the Bank of Japan. And I believe it's one of the former officials. What was his name? Sakurai, maybe? Let's see, what's his name? Yeah, as Makoto Sakurai ruled out an additional rate hikes this year, offering hope to risk assets. Next move may come in March of 20. That's wrong right there. That is 100% wrong. Should be March of 2025. Look at that. We're fact checking CoinDesk as I record. But yeah, so they're pretty much saying that next year, by March of 2025, you can expect another rate hike. Now, here's the thing why this is problematic, because Bank of Japan holds both yen and risk assets and government bonds, right? I should say they hold all three. And the problem with that is if they try and save the yen, they're fucking their own bag. And if they try and protect their own bag, then they're fucking the yen and everyone gets screwed over. There's no way that the Bank of Japan can continue to juggle this into some type of soft landing, right? Rates definitely need to go up, and with rates going up here, while rates are elevated and need to be coming down over here, that carry trade is going to unwind. It's no longer going to be cheap to borrow the yen and then put it into other markets, especially if other markets are failing and you're not seeing the price go up. Now, with Japan having negative rates for so long, and you're seeing, the U.S. stock market from October of 2022 just start to just keep climbing and climbing. Yeah, it's pretty obvious that people were just borrowing the yen, throwing it into other equity markets, and just starting to see that return constantly, constantly, constantly. They kind of bled into other, stock markets and equity markets globally as well. And that's kind of why we saw things like ARM and NVDA just keep pushing up, because we were seeing all that money being borrowed at such a low rate. The U.S. obviously the rates were a lot higher. You couldn't borrow that. We're pretty much just adding more and more leverage to the system. And I say leverage and not liquidity because at some point that's going to unwind. And it did in a big way with the carry trade. Now, there's things that can be done to prevent this going tits up, as my friend Jay Webb would say. And that is global liquidity being injected by governments and things that the Bank of Japan can do. I mean, them putting out this statement, or Sakurai putting out this statement, pretty much indicates that they want to keep the equity markets liquid for the time being. Is that possible, though? It really depends. We talked about the Bank Term Funding Program back in 2023 when it happened, and we were saying that, well, I expected that there was going to be a crash. And I said it was because global liquidity was going to absolutely get pulled out, and the Bank Term Funding Program saved not liquidity, but it saved how liquid the markets remained, right? If you would have seen a bank run across all major banks, you would have seen so much liquidity pull out of the system, right? People would not feel safe with their money in the banks, but the Bank Term Funding Program allowed there to be this air of confidence. It didn't inject a ton of liquidity. It just kept liquidity. It kept cash liquid within the system. And that's kind of what they're hoping for right now. I don't think that's going to be the case. Rates are now elevated in Japan. The U.S. economy is absolutely crumbling beneath the feet quietly. We're seeing unemployment rise. We're probably going to continue to see it rise. Wouldn't be surprised if it doubles by, I would say November of next year. There's a lot of things that could happen, and it's because rates were just held at such a high level for such a long time that it just constricted the creation of debt, which is how the banks make money and which is how the economy continues to grow. We're a debt-based economy. So that's kind of my thoughts on the Japanese yen carry trade and what's going to happen now. And now that they're not going to raise rates most likely till March of next year, they say, again, this is all just based off of what I'm getting off the internet and these articles, uh, you're probably going to see a bit of a double down in leverage, which why would people do that after what we saw? The VIX hitting almost it was the third highest VIX spike in history, and nothing blew up. Right? No, there was no firm that went underwater that we know of. There was no scare in the market, no pandemic. The S&P dropped 100, I think it was 225 points at some point at the open, but then it just kind of got bought back. So it was, I think, closed 123 down or something that day. Nothing necessarily happened, and you saw the VIX spike. Now you're seeing that leverage continue to wind up once again. And if we take a look at the yen right now, this chart, because I'm not sure if we've looked at it in some time, but the yen itself looks like it's bouncing here. But what do we know about this? This is the yen losing strength against the US dollar. There's the death cross, right? Every time we're going to get a death cross, it always wants to rally. But what are we looking at? Is this something larger or is this something smaller? What I see here is a 5-wave move to the downside, right? So now I would expect a 3-wave move within this wave 2, something like this, maybe get rejected off the 200 moving average. And this might happen fairly soon. We're looking at the stochastic RSI, and it looks like it's getting close to the overbought fairly quickly. Doing TA on Forex, sometimes it works out. Sometimes these governments and these central banks impact the price momentarily. Things can change, but I would anticipate that there's one of two things that could possibly happen. One, the yen just gets absolutely screwed. All the people in Japan are screwed. Goes to $300 or 300 yen to one US dollar, right? That'd be the worst case scenario. That's hyperinflation. What's more likely? You get rejected around here at 151.7, and then you have a major move to the downside, and we're looking at this being a major 5-wave move down. Wouldn't be the first time I believe we've seen this too. Let's go back to, might have to go back long period in time. Yeah, it probably would have been like the 1990s or so. Yeah, you see it even here, right? This is a 3-wave ABC, 5, 3, 5 within that. So you'd probably see some type of ABC correction. Looks very similar to this, right? Get 5 waves down, maybe get a bit of a rebound over the next year or so, and then just kind of finish it out lower and lower. That kind of took us into the dot-com bubble, which is really interesting, right? Global liquidity, U.S. and Japanese equity markets very interconnected with their forex as well. So what I'm expecting, bounce here, rejection, probably another leg down. That would be what makes the most sense to me. Let's look at the weekly. Weekly looks like it's completely oversold, but again, this is intervention. I don't know if we're going to go up to 160 again. That would be kind of a ballsy statement to make. I do think that the 50 moving average on the weekly and on the daily do coincide, and I guess the 200 on the daily do coincide fairly well, and I think that's going to be a pretty good level of resistance. Maybe something happens in September. I don't know. But there are signs. So that's what I'm taking a look at with the USD against the yen. I think the dollar will rise significantly, but it's also possible that the yen rises with it in terms of value. So the yen gets stronger, the dollar gets stronger. Who would be the one that kind of takes the blunt end of that? Well, it's probably going to be the euro, right? I would expect them to see some pain. Let's take a look at this on the weekly real quick. I know we're doing more Forex than I wanted, but looking at this here, we're kind of in this consolidation pattern moving sideways. It's not moving up. Some people will argue that this is a triangle pattern. I don't know right now. I still think that this is just more or less the same BS that we got back here in February, March of 2023. And I think there's a good chance that we are looking at something that could potentially be unable to break above the 200 EMA. This 200 EMA continues to be sticky, so we'll keep an eye on that. If it loses a 50 moving average, then it's pretty clear that the euro is going to be the one that loses, and you probably see the dollar and maybe even the yen kind of take the lead upon global forex currencies. Yuan doing some wild stuff. Not even going to cover that. But that is kind of what I've been taking a look at in terms of currencies, the carry trade. Now we got to get into some of the tradfi stuff. Boring, I know, but we got to look at this because this is important. So you guys know I love Elliott wave theory. I don't necessarily like always showing it because it's confusing as shit sometimes. But if we look at this on the daily, this is 5. This is 3 waves up, another 5. I expect this to be 3. I expect this to see another drop. Maybe this is the level that we want to hold. Now, I drew this white line quite some time ago. Once we lost it here, we opened here, then we just saw it absolutely tank down. So this level is definitely key level of resistance, especially where it was resistant here. Yeah, this little gap. I wouldn't be surprised if you do touch that 50 moving average at 54.02. Now, the question is, we're already finding this to be resistance. I mean, if I'm looking at this too, already what's happening, you got your A, B, C, might be easier to see on the 4-hourly. Something like that, yeah. So that's what we're kind of taking a look at, right? I think this is a corrective pattern, and this is most likely your wave 2. So I would expect wave 3 to be pretty massive. Wave 3 would fit somewhere within here, and where it could go, who knows? I think that it's very possible that, let's go back to the daily, and this is the S&P, that we test the 200 moving average, but wave 3 usually isn't the shortest. It tends to be one of the longest or the second longest, and that's because wave 5 can be extended. So if I'm looking at this in terms of 5 waves, go wave 1, wave 2. Maybe I did this wrong. Wave 3, that's wave 4, wave 5. And that could be getting us to the 200 moving average right there. Or it can extend. It definitely can extend. You lose the 200, then you're probably looking at some of these gaps that are down below. But it's also possible that we're looking at something much larger where this is even bigger. So we can say all of this could be wave 1, little bounce. Then we get wave 2 up there, something massive, wave 3, wave 4, wave 5. Right. And this is the thing I kind of want to, reiterate, that we're looking at the daily chart. I mean, things can correct on the daily pretty quickly. In a crash, there is a good chance that you could see, volatile movements, and you could see the market, rebound 200 points after being down for like 500 or so. And that kind of completes some of these corrective structures. And then, 2 days later, it's back on the move to the downside because that's just what we're looking for, right? It's just part of the structure. An ABC corrective structure, probably a lot bigger than most people expect. It just depends on how many nested waves there are within it. But where I'm looking at right now, just long story short, for the S&P, I expect that 50 moving average to be key level resistance. 54.01. I know some people are saying that we get a double top. I see 54.1 being the major level of resistance. That's just my opinion. What I'm seeing in the charts, daily stochastic RSI is getting pretty close to overbought. I'm sure we will see that by some point in the week, maybe by Wednesday. But we look at the NASDAQ as well. No difference. I think the 50 moving average here at 19,086. Pretty good level to see that it's probably going to be resistance, but I do think that we're going to continue to see this move to the downside. And again, I'm seeing very little price movement to the upside and a lot faster oscillation on the stochastic RSI. Doesn't tell me that there's a whole lot of strength within these moves. So that's just something to keep an eye on. Now, the reason why I think it's very possible that we can be getting something like this is because of a few stocks, primarily this one right here. Let me pull it up. This guy right here, NVDA. We talk about him quite often. I'm thinking that there's some things in these charts that are really interesting, and we're going to have to break it down a little bit further in here. Now, what I'm seeing here on the daily is pretty interesting. Let's get this color different so we can see what we're doing. Let's make it brighter too. Make it a little bit thinner. There we go. So this white line right here is what I'm seeing as an ABC corrective pattern. I think we've got 5 waves, a 5-way move to the downside here. We could say, wave 1, wave 2, wave 3, wave 4, wave 5. Now we're getting our ABC. And it's interesting that we're getting our ABC, and you see the stochastic RSI is getting extremely close to being overbought. We've got the 50 moving average right here. Why this is important is because earnings come out in 16 days. And if the structure that, kind of been charting is what I think it is, which is something like this. One, two, three, somewhere here, 4, 5, and then you get the ABC here. What would come next? And again, ABC corrected pattern on the macro. On the macro, these are smaller time frames. On the macro, it looks something like this, right? You could say something like, let's say a, I don't know if it's going to go that high. It could look something like that, right? It really could. Let's see. I just don't like it when it looks too oblong. It's better. Better yet, let's do it this way. Same way that came out on this side, it's going to play out on this side. It seems more likely of a scenario. So, if this needs to finish, we're looking at about $83 or so where this first A wave could end up. And you could get a really short B wave in between that, just ranges between 82 and 96. Now, you can get that in a matter of days, as opposed to, something that takes, weeks. July to where we currently are, and we're almost done with this. I think once it is done, I do think that that's going to cause us to maybe get a bounce somewhere, key level of support. But then after that, you lose $83 or so for NVIDIA. You're coming down to about 50 to even close to about $32 within that range. I got this gap down here. Let me see if I can duplicate this. Can I duplicate it? Yes, I can. We'll just make this one this color, and then we'll just change it to, that's crappy. There you go. All right. It's within this little range right here. It's between this red and this yellow. So that's kind of big picture with NVIDIA. And it's just really interesting that we are finishing up this corrective wave right before it's about to enter its wave 3, and earnings are in 16 days. We also know that Jensen Huang selling off a shit ton of shares every single day, every opportunity. Is he selling into earnings? That's the question. At some point, it's not going to be viable for him to continue selling. I know he's probably up big on his investment, right? And he continues to sell. I think he's north of $500 million now. But at some point, it is going to be a free fall, and it's going to be harder to make a market for those. And some people will be able to buy, but it's probably not going to be the people that are expecting a financial crash that will be buying. So that's going to be something to really consider. I don't think the wave counts are wrong for this. It looks like shit. I'm going to do a better job. I'm doing this right now because I've worked for a week and a half straight, and I haven't had a chance to clean up any of the charts, but I do see this as being a little corrective wave before we get a major wave to the downside, if my counts are right. I think they are. But if you're looking down here in the corner, it's been a beat on earnings every single time. Does that mean a beat on earnings this time is going to be the thing that pushes up to all-time highs? You really don't know. You've seen some of the other Mag 7, beat earnings barely and still eating shit in post-market hours. But NVIDIA, so interconnectedly tied with the S&P and the NASDAQ right now. This thing tanks, everything's probably going to dump pretty significantly, and all those wave counts all coincide with each other to the downside. Now, I did have crypto on the agenda for today for wrap up. And again, I think I've talked a lot about just kind of what's going on in the market, what we expect, how things are interconnected. Crypto is no different, just kind of ranging this way. When I look at crypto, I think that we're pretty much just ranging right now, right? We got the 50 and the 200 very close to each other. Concerning, yes, it's right around the 200 moving average, but can it find a little bit more liquidity and push up? Sure. Crypto is known for liquidations, and I feel like that within itself is a job. But I think we're very similar places with NVIDIA's chart. We could kind of look at Bitcoin and say that, okay, doesn't break above 61, start holding above 61, then you're probably going to come down to, 51 or so? There's not a lot of support on this side, so you're probably going to continue to push down. You could be at 42 in a matter of months, weeks. I wouldn't count and say just quite yet, but I do think that in the coming month or so, we will get Bitcoin's decision to break from this structure, this sideways structure. A lot of people are saying this is a bull flag. Good luck if you believe that. I don't necessarily agree or have the conviction to believe that this is going to push up any higher. I do think that global liquidity is a problem, going to continue to be a problem. especially as we start to see things drop in the markets. Now, the equity markets, the equity markets are probably going to be the deciding factor for a lot of crypto. I think that you're just going to see a lot of people pull out of everything. I know that's not necessarily a popular opinion. A lot of people do think that crypto is going to survive, that Bitcoin was made for this. And again, I'm referencing a financial collapse of global markets, equity markets. We'll see. I just think that it's going to react more like gold. And whenever we see a panic, a financial crisis, gold is a major sell-off event. And Bitcoin's digital gold, and Bitcoin has the dominance over the rest of these assets. And we know that USDT dominance is at a pretty critical level where we do see the top of a market, and then now we're kind of moving to the upside, which tells me that we're going to see more of a selling pressure. I'm probably going to side with history on that one and say that Bitcoin acts as gold. So that's just my opinion. We'll see how that plays out, but I'm not too concerned with any of that for the time being. Now, just a few things before we wrap up today. I just want to go through in the market because I feel like we haven't done this in a while. Oil, doing some interesting stuff. Still, you've gotten so many death crosses and golden crosses within this because oil has just been sideways trading between two ranges, $88 and low 70s. Will it give up at some point? Probably. I think the tensions right now can manufacture a spike. Do I think it lasts? Possibly not. I think demand is going to be key here. That's just my opinion. I don't disagree with the fact that some people are calling for a squeeze. Totally open to that. But I think my play with oil is going to wait till it bottoms out because I do think global demand will shutter its price action. To the upside, it's going to be more of a buy at the bottom thing for me. But I'm looking at gold right now. I think we probably will get a breakout. The daily is extremely overbought for the time being. Let's look at the weekly real quick. And again, I mention this because I do think that there is enough fear in the market to warrant a bit of a squeeze, especially if the CTAs are saying that there's a lot of shorts positioned on oil for the time being. I know that was the case a few weeks ago. I don't necessarily know if that's the case now, but you're on the 50 and the 200. It's a make or break movement, right? I would have thought that it would have broken down just because I do think that we are going to see demand diminish greatly, but it's very possible that we do get that squeeze if something were to happen in the Middle East, in Europe, something of the conflict sorts. Outside of that, there isn't too much. We're looking at the bond market. The bonds are doing some wild shit there too. Very close to being uninverted. We're at the 200 moving average. Looks like we found some resistance on that. I do think that we will be inverted and pretty much back to normal where the 10 to 2 year is no longer inverted fairly soon. I think the bond market's pretty much pricing in the fact that we are going to get a rate cut. We look at something that we talked about a while ago, TLT, 20-year treasury bond. It's doing pretty good. We were buying somewhere around like 92, 91, went as low as about 87 at that time in this parallel channel, broke out of it. And now what we probably are seeing is the third wave. It's probably going to get a good move up. I would expect the 50 moving average to hold if we are bullish on rate cuts, and the 20 moving average, the 200 moving average on the weekly being some type of resistance. However, financial crises do offer different results, and we could see that in right here, January 2020, we got to move from 135 all the way to 180. It really depends on how much money is pulling into this. It seems like a lot of people have actually pulled into it recently, so very interesting to see this. I have a small bag of TLT, and probably offload it when it gets somewhere up here, but just a small play across the board. Everything else, nothing too much. I did see this one company. We can talk about the banks real quick. So it's going to be a short one, but once you get me talking, I don't shut the fuck up, which is unfortunate. Banks look like they're still doing bad. Schwab is below the 200 moving average on the weekly. PNC down a little bit. So the banks are down a little bit. I think there is going to be a lot more problems for these guys in the future. All it takes is one of these guys to, nosedive, and pretty soon everything else would follow. If we haven't seen how banks perform in the past, well, then just look at 2008, let's look at 2020, 2023. Banks are the ultimate volatile asset when it comes to financial crisis, because guess what? They're at the center of them most of the time. They create the debt. That's how the system works, and that's how money flows within the economy. What are we looking at here? Reverse repo 312. It's below this key level 595. It's quickly draining. And see how it is over the next few weeks or so. Once that goes to zero, I think that's pretty much when the crash would likely be more likely, if that makes any sense. Because when we look at what is this? This is what I want. Yeah, this is the BTFP. This shit, I don't necessarily know what's going on here. I don't think most people care anymore, but you would expect this to be going to zero, maybe one day. Other than that, yeah, there's just a lot of things that are weird in the market right now. This one company right here, you know, shot all the way down, had a 26% drop on Friday. Let's see if I can pull that up in the daily. Yeah, 26.5% drop on Friday. Someone sent this to me. And, it broke from this parallel channel, broke for another one. This is what we're expecting. We're expecting this to happen for a lot of tech companies. I think tech still has a major unwinds that it's due for it. The Nasdaq's still 18. I think the Nasdaq should be at 9. The Dow probably should be somewhere a lot lower. I think 28 around there makes a lot of sense. What was this? I mean, that's even generous, 28, because we know what's probably coming. The more layoffs that happen, the less people have to spend, the more that the margins get pushed for a lot of these companies. They will definitely lay off more people, and the cycle repeats and repeats. Then we're going to get rates at a very low percentage rate, and that's when the cycle starts all over again. So just kind of keep that in mind. It's nothing too crazy that I've talked about before, but didn't I say every time we get into these triangles, breakout, breakout, breakout? You can definitely study this stuff. You can definitely see that this is kind of interesting how you can predict some of these things will happen. Now, I will be the crazy one to say that the VIX still can go to an all-time high from here, even though it's broken out of this. And that's because nothing necessarily has changed. I still think that the S&P can drop significantly. I think the Nasdaq can drop. I think the Dow can drop. There's a reason why I'm not bullish. But, it shot all the way up to 66, closed at 38, and now it is at 20. They can crush it a little bit more, but I think eventually, once liquidity dries up, and I think that it's very close to that, the banks are in a bit of a, bit more pressures put under them. There's a good chance that we could see another spike, and I think this one could be higher than what we saw in 2020, higher than what we saw in 2008. So keep that in mind. Do with that as you will. I just think that markets are positioned poorly, and eventually they're going to wake up and see that everything is dropping in value, from homes, commercial real estate, to equities. Bonds will probably rally significantly, and here we will be at the bottom of a market, thinking that nothing good could ever come again, and that's when most people will probably be buying. So I'll leave it at that. There's not too much else to cover. I've been talking for too long. We'll be back Wednesday. Hopefully, Jay will be feeling better. If not, hopefully House can join me and talk about some of that CPI data. So thanks for always being here, guys. We appreciate you, and we will see you next time. Take care.